Good afternoon, everyone. Right? We'll we'll start from where we stopped last week. The final lesson. Just to recap what we have been doing so far, last couple of weeks. I think we have given a very all-round introduction to portfolio management. So how in a bank, particularly in a bank, who is the kind of expertise that we have. In fact, the treasury is the one who is responsible for treasury operations and all sort of portfolio management kind of thing, right? From there, we have given a basic introduction to fixed income tools. It's about treasury bonds, treasury bills, and also we have, in fact, last week done some calculations to understand how we are going to find out the price of a bond and the price of a treasury bill. And then also we covered the first week itself about stock market, how the dimensions and dynamics of stock markets. And in detail, we have dived into the fixed income tools last week. So probably today, what we are planning to do is cover entirely the risk management area. So this is a portfolio management and risk management, the course module. So I think there is some important area under risk management that we are planning to cover and today. And then again, on the same line, we have this Basel 1, 2 through 3, the evolution of that. And and also finally, asset allocation strategies. We have kind of assets. I think if you can remember, the definition is the kind of things in any organization which generates income, right? So for that matter, in banking, assets are loans and other loans related products which generates income. Those are the assets. And if you can think of a manufacturing organization, it could be sometimes the stocks, the machinery and things like these are the assets, because that, in a sense, generates or help at the end to generate income. So let's start with I think risk management. So let's think. So in fact, I promise you to give the answer to bond price calculation. So if any one of you could not get the right answer, it should be kind of the final answer. Anyone miss this, I think take a note of it, and I'll give you a couple of minutes until I find the right lesson today to copy the answer. 24 months, the final column also should be for 24 months, right? So just the 5.5 is the coupon for every 6 months. So we get 5.5 every 6 months. And finally, end of the second year, we get 24 months, two cash flows where we get the coupon plus the entire principal, 100. So the discounting factor is 12% divided by 2, 6%, since we take every 6 months cash flow. So power 1, first cash flow 6 months, second cash flow power into the power 2, 3, 4. So when we simplify, you get 1, 2, 3, 4, 5, 4 cash flows of their present values. We added up all the cash flows or the future present value of all the cash flows, you get the price of the bond. So that's the basic logic that I tried to explain it to you. So this is the final answer is price is 98.2675. All right. Hope it is clear. Right. So let's start the risk management, right? So I think so. If you have done your IBSL exams, so basically that also covers risk management little in detail, right? So mainly in a bank, we in fact are very much interested in four main categories of risks, right? So credit risk, market risk, operational risk, but I think the fourth risk category should be liquidity risk. So I think I've done mistake. I don't know. I can uh, make the correction here. So fourth category is liquidity risk, right? I think it is clear. So these are the four risk types that we are going to study little in detail. So let's go one by one. So I think so if you take all the risk categories, can someone tell me what is the risk that bank get exposed to of all these four risk categories? What is the major risk that we need to manage if you are to be profitable? In a sense, banks have to manage these risks if they are to be in the business. Otherwise, they are basically go out of business. So, can anyone put in the chat box what is the main risk type according to our understanding that banks need to must work on and manage or mitigate risks? Of the four types, what is the main type? So, one say Nidu, she say yes. Ruchika also said the same answer. Yes. Yes, credit risk. Risk is the main risk type because so what our main core business is taking deposits from general public and give it to give it credit to those who really need money. Could be businesses or individuals. So that's about 80 to 85% of bank risk. To my knowledge, it is all about credit risk. So that is what we need to manage credit risk in greater to a great extent. So other risk also very important. So though their exposure is little, if you kind of mess it up, so it can be the end of the road for the bank also, right? So, so by definition, the credit risk is the default risk, right? Financial institutions give credit, right, on contract. It's a contract, right? Banks give credit to their customers, but then the customers are expected to repay those loans, right? But when you grant those loans, there is always a risk of the customers not paying that. So meaning there is a possibility or probability that particular loan can be defaulted. So that is the risk that we are referring to as credit risk. It could be the loan granted to a customer by a bank. So also interbank transaction. So we'll in a case study also how important this interbank confidence among the banking sector. We need to keep it intact to keep the business banking the sector in good shape. So if it's not, it's going to be a top problem or issue for the entire system. So interbank transaction is so there is a opportunity for banks to if they struggle with their liquidity, always can ask for a bank which has a surplus cash position and get their liquidity issues settled or sorted out, right? So you can go to the interbank money market and get those money. So similarly, trade finance transactions. So there has series of transaction in international trade. It could be LC, where we commit to exporters. So LC is kind of a document, a letter, where the banks give the promise to the exporters through the exporters bank on behalf of the importer that a particular transaction will be settled. So without any issue. So that was the issue. I think if you remember, we had this organic fertilizer issue, right? We had a Finchao, I can't remember exact Chinese company which delivered the ship of organic matter, organic fertilizer sent to Sri Lanka, and the LC was opened by the bank, People's Bank. So there was some. So since it was the LC transaction, so they have taken action to recover that money from People's Bank, and so ultimately Sri Lankan People's Bank had to make that payment because so legally, so when the LC is open, so you take that responsibility to the exporter that you are going to make that payment. So you can't say give any reason to not to make that payment. So that's about international trade. So then, so how are you? So kind of manage that the credit risk in a bank. So let's see how ready a particular bank you can, if following. So whatever that I am going to discuss in a while in a bank, and that particular bank in a better place to manage their risk, right? So the first thing is they have very sound credit policy, right? So credit policy is something that a document. In fact, that is in charge of this credit policy is the IRM department, Integrated Risk Management Department. So they are the ones who are responsible for the entire document, starting from credit evaluation and so what are the credit evaluation criteria. So then the approving authorities, so the entire process, and thereafter, so credit administration. So credit administration is once the loan is approved, the approval is subject to certain conditions. So the credit administration department is expected to look at the approving authorities' conditions, whatever they are put, so forth, and make sure that the credit approving authority, whatever the credit approving authority, the condition they impose, being complied to. So that's about credit administration. So, and also then thereafter, you need to make sure so you have the data on month basis. So what is your overdue due loan portfolio, right? We say arrears loan statement. So you say overdue a number of days loans are in arrears, right? So these are some of the reports that you generate and see whether your portfolio is in good shape. So if the OOD is, if you can keep that OOD at a 0 level, so that's the most healthy situation, but we practically can go up to 15, 30 days. But if we go, beyond 30 days and you are in trouble, so you need to have a monitoring process. In fact, whoever the credit, people in the branches or centrally, you need to call the customers and have a follow-up. So if they still not respond, there should be a way of recovering. Maybe need to make a follow-up visit, and so everything fails. There is also always banks going for legal take action against the customers, because there is a legal contract. You can always take action against those legal contract on in legal front or courts or wherever you want. So that's my kind of monitoring process should be in place for you to manage credit risk. Yes, then. So if you have all this credit evaluation, the policy defining all these things, so credit granting process, credit administration, recovery and follow up, and also so every loan that we give, we try to take a collateral. It could be a fixed asset, or maybe so even though there is no fixed assets, there is always at least a personal guarantee or corporate guarantee. So any kind of agreement from another individual party or corporate to make sure somebody else in addition to the main contract or customer guarantee, that will give a bank a comfort. So we'll take all these things into account when we in fact sanctioning a loan, right? So with all that, so when we discuss about loans, so it is so much better if we can have 0 days, okay, arrears days. But when we have OODs, we say overdue days, right? So we kind of have a provisions, right? So when the overdue days or arrears days are increasing, we kind of have a provision. So there can be, central bank governed provisions or impairment, right? So the two, impairment is accounting term. The provision is something central bank regulator who expected us to, if the loan is in arrears, we need to keep aside part of their profit, part of the bank's profits. So just in case that particular loan is defaulted, because we are work with the depositors. One is just to make sure the moment it start, loans go into arrears, so we start provisioning to make sure depositors' money is safeguarded, right? So, like I said, the provisioning is the technical term used by the central bank to, in fact, to be in line with central bank regulation. Impairment is an accounting term, right? So those two terms you need to be very clear. So some of the things that the credit granting process, what are the things that we need to look at, right? You should just read it out. Very simple, straightforward things. We need to, when we grant a loan, a particular customer, we need to make sure that the customer has a real actual purpose. So it could be maybe house construction, it could be business purpose, expansion, working capital. They need to have a kind of a purpose for taking that loan. So also another thing that banks look at, we need to make sure that particular customer has kind of a repayment capacity. For that, we look at their income. So relatively larger loans, we take the audited accounts, management accounts, and see their in fact, we are doing forecasting about their future cash flows. And the smaller loans, I don't think we have audited accounts. In that case, you can look at the current account operations to see whether they have income streams, which is, so if they have current account statement, we can make sure that they have good income sources. So depending on their income level and their repayment capacity, we can decide how much the loan amounts that we are going to grant, right? So, so there can be individual borrowers or also corporate borrowers, right? So we at bank levels, we have clearly defined approval process where loan should be originated by a credit staff. There are now, in fact, there are credit hubs where the entire evaluation process is carried out. So then also, so we have kind of clearly the approving authority, so delegated authority, depending on the risk type and the loan amount and the tenor. So banks have DA, so commonly known as DA, delegated authority. So it defines who can approve a particular loan. So, right. And those are some of the things. And extension of credit and on relationships. So there can be order of facilities. So we need to so look at, annually we'll review those credit limits. So looking at their customers' account performance and their how good they are when it comes to conducting their current accounts. Right. To sum it up, I think we have this 5C model, in particularly in credit evaluation process, what we look at, right? So 5Cs basically, so you can see, I think I have not shared this. So let me share that. I know you have this presentation with you, but anyway, so this is the 5C model. So first C is character, and the second C is the capacity, and the third C is the capital. Fourth C is the condition, and the final and fifth C is the collateral, right? So I think these are some of the basics of credit management, credit risk management. So just to give you an idea of what each of these C means, right? Firstly, character. So character is we look at the customer and their background. We do a background check and see whether this particular customer has taken loans previously, and how, if he has taken loans, how his repayment history. So what is the document that you look at to see the credit risk of a borrower? I know you know, but just to keep things moving and to have some instruction. Yes, script report is something that we look at to make sure that these customers have taken loans and they've been paying well. So not only we look at whether they are paid or not, their repayment behavior. So certain period of time, there can be, they're in arrears for 30, 40 days, right? And sometimes even the number of arrears days can be even higher. So in those situations, we need to make sure if the arrears days are in as a habit in repayment terms, if they have very as a pattern, they have been repaying with a lot of delays. So then you should be cautious about lending to those customers. But if there are arrears days in between, you probably can inquire from the customer what exactly the reason. If the reason is justifiable, so then you can justify that case. That's the character. So basically, we look at the repayment capacity of the repayment behavior pattern of the customer. So then its capacity is all about so repayment capacity is all about like we have discussed earlier. We look at the income level, right? So a source of income. So whether they have the business generate income, right? If not, if you are giving a housing loan or a personal loan, whether they have permanent income, fixed income, employed, and getting a fixed salary kind of thing. So then we compare that their income levels, monthly income levels, as against monthly debt commitments. So if you look at their crib reports, you should be able to figure out what their monthly debt commitment. And we compare monthly debt commitments versus their income levels. And so income levels is not only the income levels after setting aside for their expenses and any financial commitments. So what is left for them to repay the proposed loan? We look at, and in fact we have debt service cover ratio, a ratio that we look at. So if this debt service cover ratio is technically more than 1, we can be comfortable, but banks look at more safe margin than 1+1, right? We look basically, so banks are confident or comfortable when the DACR is more than 1.3 or something like that. All right. If it is a lower segment, we probably look at more than 1.5 times. But if it is a corporate, we are looking at corporate, maybe 1.3 is reasonably okay, because the corporates, the financial statements, they provide the accurate details. But so when it comes to lower segments, if we rely on current account statements and estimate the income based on some assumptions, so then you need to have a relatively higher margin. So that's how you look at the capacity of the borrower to repay. And then the third C is the capital. So if a particular customer wants to invest in a project, so how much of money that the particular customer is willing to put this capital, equity participation, equity contribution. So let's say the project is 10 million. If the equity or the customer also willing to put 3 million, so 30% is capital. So then bank is confident, because unless he commits, so we can't commit our depositors money. First, customer should be confident of the project and its cash flows, the concept or the product or the project, and the future cash flows he's planning to generate. So that's about the capital. We are looking at how much of capital customer is willing to put in. So the condition, basically, I think most of the students get confused, or they are confused at the moment. So the condition is the condition of the economy, right? So if the condition of the economy is favorable for that project, I think we say it is good, satisfactory. So for an example, tourism, maybe with the COVID and there is this Easter Sunday attack, it went into a lot of trouble, right? So those days, even right now, there is a hesitancy from the banks to lend into tourism sector, right? There is a lot of encouragement, but a lot of hesitancy from the banking sector, because the economic situation in the country is not favorable. Economic condition is not favorable for tourism, right? So that is the condition we are looking at, economic condition for that particular project, not the condition of the loan offer letter or something like that. So we're looking at the economic condition, whether it is favorable or not. So then, having looked at all these aspects, character, capacity, capital, condition, still, so we actually play around with depositors' money. So in that case, we need to make sure we have some collateral, just in case if something happens or there is a default. There is always a default risk. So for us bank to take action, we need to have a collateral. It could be, like I said, personal guarantee, corporate guarantee, but in most cases, banks look at tangible collateral, right? So because this impairment, so if a bank has a lot of unsecured loans, so that the impairment charge of their P&L is relatively higher. So to have a control or strike a balance, banks always look at taking a tangible security to that to minimize the impact of impairment on the profitability also. So we are still in the credit risk the process, right? Then, like I said, so we credit administration, we have various risk bearing portfolios, we need to manage them, right? So in banks we have this internal risk rating models, right? So we need to make sure internal IRM department, we need to make sure that those risk rating models are up to date. If not, they have to take precautions to make sure your risk rating models are in good shape. And so also there can be early warning signals that bank level that we are looking at. Can be analytical tools to check whether the portfolios are in good shape or not. So if there is any alarming signals, bank has to need to take action to minimize the effect of credit risk. So also, so always there can be so need to make sure there's concentration risk kind of thing, how much of the bank is exposed to a sector, right? So for an example, like I said, if our banks manage the sector level exposures, so in a kind of very healthy manner in 2017, 18, 19, 20. So if you have not exposed to credit in a tourism sector in a big way, so banks would have managed that risk. If any bank has a relatively higher exposure to tourism sector, so once we got this hit from the COVID and the Easter bomb attack, I think they are in trouble. So like I said, so there are so many sectors in the economy. The tourism is only one sector. There is trade, services, manufacturing, agriculture, so many other IT-related services, hospitality, hospital sector. There's so many sectors. So banks always must take uh, uh, also practice due diligence when lending by striking a balance when they are actually taking their credit decisions, right? So if you see, these tools are analytical tools are there to direct you. If you see your exposure level to certain sector is higher, certain customers, certain groups. So if your exposures to maybe John Cales is higher, so then it should alarm you. So if something happens to John Cales, you are going to get hit. So that type of risk, your credit is relying on one or two customers. So John Cales, your exposure is relatively high. So yes, credit risk. So what is that risk type is known as? So if you are exposed to one or two customers in a big way, right? Yes, a type of a credit risk, but we give a different name for that. What is that name? A term that we use. Getting exposed to one or two plus customers, credit in a big way. So always talk about single borrower limit, right? So in compared to your equity, how much you can lend to one particular customer. So all this comes because of that one particular risk type. Yes, I gave, I think, little time. I did it is concentration risk. So if all your portfolio is concentrated on one particular customer or two, so then if something happens to that customer or sector, you are in trouble. So that is called concentration risk. So that is the reason why banks, again, regulator, the central bank has put a condition to how much particular lending institution can lend to a single borrower to mitigate or manage that single concentration risk. So similarly, we need to have a very sound process in place to manage the credit risk. So now we are done with the credit risk. So then we are moving into interest market risk. So there are so many types of market risk. So interest rate is the price of credit deposits. The price is the interest rate, right? So interest rate is always, it can go up or down. Oh, so this there is so the risk of I think any assets which is actually driven by interest rates, that is, it is actually exposed to interest rate risk, right? So for an example, so if you bank has borrowed money for 1 year and lent money for 3 years, both on fixed interest rate basis, you are in fact exposed to the interest rate risk, right? So we have an illustration also later on with I'm explaining together with liquidity risk. So just for the moment, so we actually take we fixed depositors money. So let's say we take for 10%, and so that is short term. So we lend it to a 3-year loan, right? So 10%, we let's say we lend it at 13%. So after 1 year, so 3 years now, so you are getting at 13% for 3 years. So if the 1 year down the line, let's say, hypothetical situation, so depositor who placed that deposit 1 million come and take that deposit 1 million. So anyway, bank has to keep going. No, bank takes another deposit at 14%. So now for next 2 years, that 1 million costs the bank 14%, whereas year before we have given a loan at 13%, which generates income at 13%. So you have 1% loss, right? So that's how you are getting exposed to the interest rate risk. Similarly, that it is common for that's in fact so if your interest rates are going up and down, but particularly interest rate moving unfavorably, so you are going to lose your profitability income also. You are going to deteriorate income also. Yes, this is for example. So similarly, that's interest rate risk. There are so many other risks. So therefore, there can be foreign exchange risk, equity, stock market. If you invested in stock market, commodity risk, right? You can have a commodity exposure. So any of these risk types you can get exposed to due to the changes in the prices, right? So we've learned the first day, I think, about foreign exchange. So the 203 dollar rate, if it moves to 205 tomorrow, so then you exposed to foreign exchange rate risk, right? So similarly, stock market, let's say today a company is listed in the share market at 100 rupees, it can go down to 90 or 80 rupees there, where the investment getting value getting deteriorated, right? So stock market prices come down, so you are at a risk of losing your value of that asset, right? Equity. So similarly, in the commodity markets also, you can get exposed. So these are the basically the market risk is the risk attributes to changes in the prices of any investment tool. It could be loan, it could be fixed asset, or any or equity, commodity, or any other assets that which generates income. So then we talked about first credit risk in detail. So we have spent a fair bit of time on credit risk because that is the main risk type that we are exposed to. Then we discuss about market risk. Then comes the liquidity risk, right? So liquidity risk is the risk that banks or any financial institutions inability to make internal or external their stakeholders, their liabilities, their inability to make the payments for their liabilities, right? For example, so interbank, you take at interbank money market, because of due to your liquidity issue, you take some money to smoothen your liquidity issues. But if that particular bank cannot, you know, honor that commitment, then that is the due to some difficulties in their cash flows. So then it is going to be liquidity crisis, right? So it is basically the bank's inability to service their debt or any other financial obligation due to internal and external factors, right? So that is the liquidity crisis. So liquidity crisis basically in banks happens due to mismatch between assets and liabilities. Like I said, you take deposits for 1 year, but you lend on relatively longer term. So as a result, but the the cash flow inflow comes into the system, it is on short term, but goes out on long term. So these tenors do not match. So as a result, you always find it difficult to keep your cash flow situation in good shape. So as a result, you get exposed to the liquidity issues. But banks have different ways of managing that risk. So that's what you should know what is liquidity risk, and also should know to manage those liquidity risk. So we know bulk of the cash flow come from depositors, which is short term. So if it is short term, if you are lending in long term, you need to have alternative ways of uh, managing that, because that's what we have learned about. In fact, interbank money market, where you can smoothen your cash flows. Then you learn about debentures, so you can go to the market and take money, and also commercial papers, asset-backed collateralized securities, right? And commercial papers, and we can take loans from central bank, repurchase agreement, reverse repurchase agreement. So there's so many tools. Yes, it is deposits the main flow, cash flow coming into system, but there are so many other alternative ways that banks have to manage that risk. So in fact, banks have credit lines, dedicated credit lines. So they not necessarily take money from those credit lines, but they book those credit loans and approve and keep it, just in case they need in an emergency they take. So otherwise they don't take money. So those are contingency plans, right? So the contingency credit lines are also another way of managing liquidity crisis of the bank. So now we know 3 types of credit. So this is the illustration that I wanted, little while ago, that I explain you. So this is very clear here. So you take 1 million here at 7% per annum, fixed for 1 year. So on the first day, you take that money, and a loan, we are giving a loan to 3 year. We are giving a 3-year loan, so which generates income at 10% per annum. So based on that assumption, we are getting end of each year 333,333. So let's say if we take 1 year deposit, no. So end of the first year, that particular customer can take money, but banks need to have a plan to have a smooth cash flow. But let's say you take another deposit, 1 million, but so that's the problem now. So you have you only get 333 1,333 end of the first year. So then when the customer comes end of the first year, you only have 333,333 plus you have given that 1 million loan. So when the customer comes, you don't have money. Yes. So that's a problem. To mitigate that risk, you need to take another deposit before that, right? So, but this the issue comes, this liquidity issue comes because of the difference in the maturity period. So deposits usually 1 year, loans 2 or 3 years. So because of this difference, you exposed to liquidity crisis. So similarly, let's say, so yes, we take another deposit to make keeps things rolling. But like I said earlier, if the interest has gone up by that time, so let's say to 10%, so then so you are getting, let's say 11% for our understanding purpose. So you are now so each of these next year you are need to pay 110,000, right? 110,000 as deposit, but you are getting interest rate at 100,000, right? Still you are getting 7%, right? 70,000 per annum, right? So your interest cost is 110,000. Your income is now less than your income. Your costs are relatively higher than your income. So because of that, your profitability is getting affected, right? So those are some of the things that you need to clarify, right? So this is example illustrates both the liquidity issue and the interest rate risk both together in this illustration. Let me go once again if it is not clear. So you take 1 year deposit and you give 3-year loan. So when you give 1 year deposit, you are expected to get 333,333 in the first year. But so when the customer depositor comes on the end of the year one, you don't have money. So, but it is not the case in many cases. Banks take many more deposits before that, right? So, yes, but you can take, but due to this mismatches of maturity period of asset and liability, asset is loan 3 years, liability deposit first 1 year, you get exposed to liquidity. That is the liquidity risk, right? So now the rate issue, right? The interest rate risk issue, pricing, market risk that we are trying to explain is the deposit you have taken at 7%, right? So it costs you basically the first year itself 70%, 70,000. So then you have actually your income is 10%. So your income, the first year income, you got 100,000. You have 30,000 profit. So now customers come and actually we wanted to deposit. We have given that deposit. The now new deposit that we have taken, let's assume for the moment it costs you depositor because of the interest rates, fluctuations, market risk has gone up. Now we take that deposit at 11%. So now deposit at 11%. So next year we are paying for that deposit 11%. So then 110,000. So but still the year one we have taken a loan at 10%. So we are getting for that year, right? So you're getting only so if the entire 100,000 was there, 100,000 at 100,000, but the now loan outstanding they paid 666,000, right? So we are getting only let's say about 10% of that 667, about 70,000. You actually your cost now new cost is 110,000. You are only generating in that particular year for that deposit. Your first loan we take, you only earning income 70,000, you are losing 40,000. So that's the interest rate risk, right? So so with that, we'll move on to, now we discuss about three types of risk: credit risk, market risk, and liquidity risk. And then we'll move on to uh, price of the operational risk. So let me see if you have any questions so far. Doesn't look like you have any issues. Yeah. So operational risk is where you get exposed to risk when you are, when you are doing your day-to-day operations. It could be in legal fronts, in the processes, where people can make mistakes, the systems can, uh, there can be, they are also susceptible to, there can be system downs, the documentation, there can be errors in legal documentation or any documentation. So because of that, you get exposed to operational risk. So basically, operational risk is defined as uh, it is something that you exposed due to inadequate or failed internal processes, people, or systems from external events, right? Uh, it could be due to, electricity issue, your systems, you don't, your generator, if you don't have generator, your customer service go for six, right? So that is external event, right? Uh, so that internal processes can be faulty, right? So you have a system internal guidelines. You are to say that so counter staff need to keep the cash. If you collect 500,000, go and keep that in the safe lockers. But if you keep it, so guideline says 500,000, you go and keep it in the safe locker. But if you don't comply, so you have internal process inadequate, or you don't fail. If you don't have a system, so then you are anyway prone to operational risk. So all of a sudden, if robber, get into a bank and take that money, 500,000 on the counter, so then you are losing bank's money. So you are exposed to operational risk. So mortgage document or legal document, you have to put the identity card and the names and all the details in a proper manner. If you make mistakes, you don't actually type the customer's name properly, or not put the identity card name properly. So see, customer can in fact fight that kind of a situation in courts. So, in fact, if you being professionals, if banks don't, uh, take professional approach when it comes to executing their documents, so courts also can take decisions against you because you are professionals. If you can't take the right decisions, if you don't have processes, there is no excuse. So you are exposed to operational risk. So basically, risk of resulting from inadequate or failed internal process, people and systems, so from external events. So losses that can happen due to failed internal process, people, system, or external events is the external operational risk. Right. So these are some of the types of internal fraud. So if you don't have an internal guideline, you are easily can internal fraud take place. External frauds, robbers can come into your banks, getting contact with your internal stakeholders. You can lose a lot of your money, right? Physical damage can happen. So if you don't have insure, you can lose a lot of money, right? So frauds, there can be robberies, credit frauds, money laundering. Their willful blindness is something that someone knows that something wrong is happening, but keep a deaf or blind eye. You just pretend that you have not seen, but you know that. But money laundering is not the area. So there is no excuse. Right. So I think so. With that, I think we come to the end of risk management section also. So another important area, so that we need to know a little bit about risk management. Major risk types. So what is the example for risk type and how are you going to manage that risk, right? So that those are the things that you need to know about risk management. Right. Give me 2 minutes just to have a small glass of water. Right. So let's move to the next lesson. So it's about, again, about risk management, still in the risk management. So let's see. So let me see whether you have any questions so far. No? You can, if you have any questions, you can put it in the chat box, right? So now we are moving on to so managing all those risks, right? Could be credit risk, uh, market risk, liquidity risk, operational risk, basically. So yes, banks to a certain extent can manage those major risks on their own, but they also on their own must take uh, really uh, prudent action to guard against those risks. That is very important. But so luckily, particularly the banks have this regulator. So in Sri Lanka, regulator is the Central Bank of Sri Lanka. So maybe in USA it is federal bank, and India also Indian, the Reserve Bank of India. So these are the central banks. So in different countries use different uh, terms for central bank. So they, in fact, intervene and set a guideline, issue circulars. So they, in fact, in central banks, governors, so they have a different forum, right? So the Basel is something that where so all the central bank governors get together, right, and take decisions with regard to mitigating or guard against all these risks. So all the governors, uh, in fact, get together in one particular location. That's Basel is the city name. So in Sweden, I guess, yes, if I remember correctly, it's Sweden. So Basel, that is the city. Everyone gets settled. There is a forum like G summit. You get all the countries from the big economies like Japan, US, UK, France, Canada, the countries like that get together and take some decisions. Likewise, central bank governors all over the world get together and take decisions to safeguard the financial system, not only in one particular country, entire financial system. The reason being, so if any of these countries' financial systems face with an issue, in fact, it is not limited to that country. It goes beyond the territories of that country. That's how we are interlinked right now. So that is why the countries don't want any of the countries to go bankrupt. It goes bankrupt, so entire system get into trouble. That's why one reason why. Uh, most of these countries, not in the recent past, they don't get involved in large scale wars. So in 90s, we had a lot of wars, right? In 70s, 80s, so Iraq, Iran war, so USA invaded Iraq, so then Afghanistan war, US got involved, Vietnam war, so all these times, so economy, so went into trouble, in particular those countries and on the world. So as a result, those countries don't get involved in wars, right? Because it is going to hinder the economic growth and also economic performance of that countries. So coming back to our point, the central bank governors get together and take decisions. So Basel 1, 2, 3 is kind of a forum where Basel 1 is where the first decision they have announced, right? So then the Basel 2 comes, the second decision they announce, the safeguards. But particularly when there is an issue in the financial system, they do a lot of research, ongoing research. Before we get into issues, now they come up with certain recommendations, and so taking a clue from the entire Basel 1, 2, 3, particular countries, central banks, regulators impose or put certain guidelines to their commercial banks in this respective countries. That's how Basel 1, 2, 3 come into effect in local banks, where we also need to be bound by. So the first one, so like I said, so the unique thing about the banking business is the depositors money, and you lend it, and you can, the owners or whoever manage that, if you can manage that well, the whoever manage can make profits. You don't want to take capital, right? You take money from the depositors now and give it to the lenders, loan, those people lending it to the people who need money. You take money at 6-7% and lend it at 9-10%. So there is margin, you make profits. So as long as those people keep paying, banks making profits, right? So but it is not the case, right? So when you take money from an outside, if you don't have a responsibility, so then the issue comes. So you are actually giving somebody else's money. So you can make a lot of profits and you say bye-bye to depositors. But to prevent that happening, you are actually, regulator is there to monitor, right? So give certain guidelines. So since there is a possibility the banks can play around with depositors' money, the first thing that Basel 1 recommended was whoever managed that bank, the owners need to give their own capital, put their own capital, if to make sure if something happens to loans that give, so then they have their capital to set it off against, absorb those losses. So in one way we have that option of taking that capital to cushion against the losses, and also on the other way, the owners also take the precaution, because if they lose their capital. So they take the precautions to make sure the banks manage in good shape. So that's another idea. So that both ways banks can get the risk can be, the credit risk can be mitigated, right? So, but initially, so Basel 2, so it's a very initial, the kind of primitive discussion, because very early stages. So I think to couple minutes. So I think you lost me So supervisory review will start from supervisory review. In pillar 1, in fact, in Basel 2, the system is there to calculate the minimum capital requirement for all major 3 risks: credit risk, operational risk, market risk. I hope it is clear to you. So from there, we have in fact discussed thereafter pillar 2, supervisory review process. Right? In supervisory review process, so basically, internal rating models can be developed by banks. So big banks can, in fact, using their expertise, and maybe they can get the help of a consultant, can develop their own internal rating model, right? So, so all these internal rating models need to be subject to review by this regulator. So there can be internal rating models. Certain things can be missed out. Certain factors like they could, credit concentration risk not be taken into account. So maybe interest rate risk or the entire market risk calculation is wrong, right? So business cycle effects have not been taken into account. So they are doing it internally, so their expertise may be different. Central bank, they have higher level expertise who work with not only in Sri Lanka, work with the cross-border currency. They have so all this access to information, expertise, knowledge is the central bank. So as a result, they can supervise and see what exactly is done with regard to the process of capital calculation requirement is correct or not. If not, they can give their recommendation. So the more important thing is under pillar 2, the regulator is supervising the process of capital calculation of capital and taking all risk factors into account through a supervisory review process. And then next, the market discipline. So all these the exposures to risk and the risk mitigation methods of all the banks, they discuss in detail in their annual reports, right? So annual reports, they in fact discuss in detail. There are a couple of sections in annual report we are going into detail. They introduce they discuss about the tools they introduce, framework that they use in managing their risk, right? So as a result, any investor or depositor who wants to keep their money in the bank can go through the annual report and see to what level the bank is safe with regard to managing their risk. So thereafter, having reviewed that, going through the risk management process, they invest. So then, if at all, then they take a educated judgment decision, right? For that, they have the information in hand. So that is one way. The bank, one way the customer or the investor is aware of what the level of risk they take. And by having a market discipline like this, there is a competition among banks to identify and use their knowledge to put it in writing, to keep in record, so what the actions they take. And so outsiders can, in fact, see to yourself whether they are actually implementing that or not. Right? So all these things, there is a competition among the banks to have a best of the best risk framework. So in that way also our depositors and investors also getting safeguarded. So that's about market discipline. So hope that is clear. So hope what you missed during the 3 or 4 minutes before the break, it is covered. Right, great. So straight away we'll go to Now, straight off, we'll go to the Basel 3. So the Basel 2. So we talked about Basel 1, there are deficiencies, standard method of calculating risk weights, giving risk weights, and taking only credit risk. But the Basel 3, so Basel 2 to Basel 3, so there's evolution. Again, the Basel 3 to come, they definitely introduce some good things in Basel 3 when compared to Basel 2. That's the reason, the whole reason why Basel 3 exists, right? So what are the new things introduced in Basel 3, right? So like I said earlier, just concentrate on what I say rather than going through, maybe it can be complicated, but if you really listen to me, so it is it's common sense, right? So Basel 3, the Basel 2 to Basel 3, so they in fact wanted, so just read through the first couple of points. They actually published in 2010. And is expected to be phased in between 2013 to 2019. So in fact, they have introduced this 2010 just after the global financial crisis that we are going to discuss in detail in a case study. So they had to face series of issues in 2019 during global crisis. So having faced this situation, they have introduced Basel 3. So definitely there were some issues in Basel 2. So that not taken care of the situation, and when things went out of control. So Basel 3 introduced to, in fact, to take things under control. So, but you can't immediately implement this. So 2013 to 2019, given the freedom for the banks to have their own methods, come out with their own methods to implement according to their time frame. So this in fact further strengthen the regulation, supervision, risk management of the banking sector. Basel 3, in fact, a stronger version of Basel 2 help supervision process, the regulators supervision process, risk management of the banking sector. In fact, here, so not only talking about the regulatory capital, minimum capital, not only about the amount. Here we are talking about the quality of the capital also. The difference here is the Basel 2 only talked about the quantity, the amounts, minimum capital requirements. Here we are talking about both the quantity and the quality. So what is the quality? We'll come back to it in a while. So then, so all these, so improve the banking sector, help the banking sector to absorb shocks arising from financial and economic stress. So that's the same thing in financial in 2019 global crisis. So hopefully, so the introduction things that introduced in Basel 3, quantity and quality of capital, help them to improve the risk management and supervision through Basel 3. So, and also so not only on balance sheet items, right? So they have actually taken account of the off balance sheet items. Like, so what are the off balance sheet items? So in the second day, I think we discussed the balance sheet items, loans, the treasury bills, treasury bonds, rupees, notes, coins, everything is within the balance sheet. Off balance sheet items are bank guarantees, letter of credit, export bills. Actually, there are some of the liabilities not listed in the balance sheet. These are off balance sheet, but they also have some exposure if things go right. Okay, but there is also risk element. So in Basel 3, it is expected to take into account the off balance sheet exposures and keep aside capital for that as well, right? So for an example, if it give a 100 million bank guarantee, so you need to keep a percentage of capital for those bank guarantees also. So then so overall, is improve the consistency and transparency of the capital base of the commercial banks, right? And so basically defining all the types of capital instrument they use, right? So so the quality of capital, the tier one, they introduce in the Basel 3, two types of capital, tier 1 and tier 3, tier 2. Tier 1 capital, so also take into account going concern capital, right? Share capital, share premium, and retain profits. I think so the capital which is important definitely in going concern of the business. When the business is continue to exist, this capital is very important. Share capital is capital invested by the shareholders. Share premium also belong to shareholders. Retain profits, whatever after all the profits, dividends paid. So what is retained in the inside the organization as also form part of equity. So that is very strong quality wise, very high quality capital, right? So it forms the top tier 1 capital. Tier 2 capital, not very important capital, but also, but again part of the capital, not so important going concern. Revaluation reserves is part of the tier 2 capital, but it is quality wise, it is not very high quality capital. So so in Basel 2, it always we talk about capital, but here quality wise we have categorized into two capital qualities, tier 1 and tier 2. So that's one difference in tier Basel 3. So we talked about in Basel 3, these are very detailed thing. You just have to have a basic idea. So maybe you can remember what is highlighted in red. So these are some certain things that you need to remember. So capital, so we I told you in Basel 3 define capital in more detail, right? They talked about capital also taking into account both the quality and the quantity. So this capital is very well defined here, and it says quality and level of capital, 4.5% of equity, right? So they actually wanted 4.5% of equity. So tier 1 kind of capital. They not generally talked about capital. They want that high level 4.5% of capital to be kept aside as a capital minimum, part of minimum capital, right? So then they also wanted to keep aside capital conservation buffer, 2.5% of risk-weighted assets, and total common equity standard to 7% constraint. So again, common equity up to 7%. Again, quality. They wanted the quality capital to conserve. And so again, also the banks, big banks who are actually growing their books very rapidly, they wanted to keep big banks like maybe commercial banks and international banks, and also this systematically important banks like in Sri Lankan terms, the banks which have more than 500 million assets are considered to be systematically important, because these banks need to be in good shape for the system to to be in safe environment. If something happens to big banks, that automatically affects the entire system. So systemically important big banks are expected to keep relatively higher level of capital, quality capital. So as a result, the big banks are expected to, in line with their credit growth, the portfolios, they are expected to keep the amount of capital they are expected to keep also relatively high. So if they want to grow, they want to grow the profits and equity base also, quality capital. So otherwise they can't grow their the loan books and make profits, putting their depositors and the investors at risk, right? So that is area that you need to be look at. And leverage ratio, that containing leverage, so they are again that shows non-risk based leverage ratio. That includes off-balance sheet assets also, right? Exposures as so. Like I said, Basel III take into account leverage ratios where take into account the leverage ratio. It's about the total, about 3% of the total, including off-balance sheet assets, 3% of the capital. So that's something that you need to keep in mind. So in addition to capital ratios, in Basel III, they introduced two separate liquidity ratios. That is very unique thing. So in addition to capital requirements, they introduced two liquidity ratios: liquidity cover ratio 1 and net stable funding ratio. This is two ratios introduced, and in fact this is another ratio that banks have to calculate and need to disclose and need to show it to the central bank, and need to be within the given ratios for bank to ensure the banks are in good and safe hands without going to liquidity crisis, right? So basically this shows how important the quality of capital, and uh, how how banks take into account, how Basel III take into account the off-balance sheet uh, uh, when recommending ratios for other banks, and also the latest and the newly introduced two liquidity ratios is about liquidity coverage and stable funding ratio. So like I said, so central bank in 2013 when they introduced, they have given all the banks a time frame until 2019 to introduce and implement these areas and have their own methods. And but by now to the 2022, so all this should be in place. All the banks need to maintain 2019 the ratios that minimum, the capital common equity capital ratio 4.5 across all banks. They should maintain that capital conservation buffer 2.5, and again minimum continuous equity plus capital conservation buffer it's 7%. And so maybe for systematically important banks need to keep another 7%, and so another phasing deductions set 100%, and the minimum tier 1 capital 6%, minimum total capital 8%. Some of the ratios, minimum total capital, those are the quantity, and qualitatively those are the ratios that they use to improve the quality aspects and quality and quantity aspects of the capital. And liquidity ratios on the bottom, so those are the two ratios. They want 100% of those ratios in from 2019. So details about liquidity cover ratio, just to give you an idea how this liquidity cover ratio is calculated. If you have a balance sheet and cash flows of the banks, if you definitely in the annual reports you have stock of high liquid assets. You need the first in the numerator, you have the stock of high quality liquid assets. What are the liquid assets? Cash, notes, liquid assets, treasury bills, treasury bonds. Those are the high stock of high quality liquids. Let's assume the bank's one particular bank has 76.35 million high stock of liquid assets, and total cash outflows. And we have in the cash flow, we have total cash outflows and cash inflows. We have that. Let's say you have those two figures as well. We know exactly what are the cash inflows and cash outflows. I think we learned in the first week itself what are the cash inflow, what are the cash inflows, what are the cash outflows of the bank. So since now we have these two items, then from that we can derive P outflows. That is the total cash outflows cash inflows, the difference is the total net cash outflows, right? So LCR is actually calculated by A divided by B. So LCR is 254.08. I think this gives a kind of very comfort. This is more than 100%. So like central bank recommended, so LCR ratio is more than 100, 250% is more than 200%. So within the stipulated ratio. So net stable funding ratio is against available stable funding against required stable funding, right? Available stable funding is available stable funding is something that the deposits which are to mature in more than 1 year period. So what are the cash readily available in the system? If the fixed deposit in fact matured after 1 year, you have a very liquid, that mismatch of tenor will not happen. So we'll take into account the amount of deposits and the loans to be matured and paid off after 1 year. So you take the total amount and required stable funding. Required stable funding is how much of disbursement be done in 1 year, how much of deposits be settled, uplifted within 1 year. So if you have stable funding, more than 1 year mature deposits and loans to be settled, you have more of that against what you have to pay. So then your inside cash liquidity issue won't be that much great, because you have a very comfort, because what you have to settle will be after 1 year. What you have to pay within 1 year is greater than what you have in the banking system. So that's kind of a comfort that we are looking for. So net stable funding ratio basically so basically they look at both the stable funding profile in relation to assets and off balance sheet activities, right? Both in balance sheet and off balance sheet also. And so as a result, if you have more stable funding to settle, so which are to be matured after 1 year, you have very high level of comfort, and as against so what you need to settle. So then it shows so the liquidity wise you are not into get into trouble. If that ratio is more than 100%, always you are not in not in crisis. So those are some of the things that we discussed in detail. So I think we some area. So in the questions that we set, it's a testable area, right? So for exam point of view, I can put maybe 5 marks question here and there, because it is rich area for exam point of view. Just to make. I hope you learn it, listen to it seriously. If not, just go through it more couple of times over and over again until you because since you work in a banking setup, it's always very good to know what is this Basel 1, 2, 3. So maybe Basel 4. It is also due. It is in the process. So next couple of years, we expect Basel 4, maybe with some improvements to Basel 3, and it will evolve into a system which again strengthen our financial system, add more strengthen safety, transparency to the financial system, and safeguard the financial system. Essentially, safeguard the entire the world population. So that is something positive when it comes to that's learner things. These are very important. So it's not always talk and talk. We need to listen, do research, and we need to find what went wrong in the past for us to strategize and make policies in the future. So grow business. So all these are very important. It's not that driving the market sales. Also, we need to look at at head office level. It's very seriously take into account. So on that firm footing, so they take policy decision. Also, central bank also supervising, and responsible banks. Your banks also take responsible, act as responsible citizens and take their own decision. Banks also have a very high level, skillful, the professional setup who is running the show. So they keep things moving and also take corrective actions necessary. So that concludes the all about risk management area. So I think I must go and check whether you have any questions from this area first before I'm moving into the other areas. All right. Let's move on to very small area. Takes about maybe maximum 10-15 minutes. I said asset allocation, the fundamental. This is in fact so far from the beginning, first week up until now, we talked about at macro level, right? So at bank level, so central bank level, what do we do? So now we actually deviating from that. We have to cover a very small area. So maybe they are so bank level, maybe investment banking. So maybe at high level, those who are handling high net worth customers, this could be a little useful. So I think because of that, we have brought this area. So at asset allocation, the fundamental, that is, this is to something to do with, so maybe investment managers perspective, what are the key things that they need to do, right? When you are advising, maybe investment perspective, investment manager, let's assume that you are an investment manager of the bank. So you are giving advices to your top level customers. What are the things that you need to know about fixed income securities, risk-free assets, and about stock markets, how we are going to manage or portfolios of your high valued customers to give them the best return, right? So that is the whole objective. This is kind of micro level thing, individual level thing, but so far we in fact discuss in detail about macro level, how bank level we are managing the risk, right? So here we are talking about investment manager who in turn look into the investment uh, requirement of their clients and take decision, right? These are basically the investment manager's decision. Uh, we can classify into two areas, right? So one is we should know what are the risky assets and what are the risk-free assets, right? So these are the one area that so the one question that they need to know, what are the risky assets and what are the risk-free assets. Then about risky assets, so how are you going to divide and distribute your risky assets? So risky assets also not entirely risky. Some are extremely risky assets like stock markets. Some are not so risky assets, businesses. So you need to have that broad idea. So basically two things, you should know what are the risky assets and what are the risk-free assets. And of the risky assets, you should know what the degree of risk also. Risk-free assets, what are the risk-free assets that you know? Can one tell? So since I didn't ask you any questions, uh, screen is not shared. Give me a second. Hope I'm done. Can you see now? Yes, right. Okay, we'll go ahead. So nothing much. This is what I basically you should know what are the risky assets and risk-free assets, and we should know of the risky asset what degree of risk also, right? So stock market, if you are investing in stock markets, so it is going to be relatively high. So can someone tell me what are the one or two risk-free assets, just to break the monotony, to get some feedback from you all? What are the risk-free assets? Quickly. What are the risk-free assets you know that we learned in and out? Invest in treasury bills. Excellent, right? So treasury bills, treasury bonds are risk-free assets. So other than treasury bills and treasury bonds, any other investments or assets can be classified as relatively risky, but stock market is the highest level risk. But so we'll give some illustration of degree of risk of certain assets in short in a while, right? Uh, basically, when you look at risky asset, you also need to look at risk return trade-off, right? So higher there is a correlation between risk and return. So what is the risk return correlation? We learn about it. We take the question also. What can you say about in investment? Uh, is there a positive relationship of risk return relationship, or positive or negative? What can you say? High risk, positive. Very good. Excellent. So, meaning that you understood what I said. So, great feeling for me as well. So, higher the risk, higher the return. Uh, so as an investment manager, so you should know of the total investment, how much you invest in risk-free assets, right? So, as a bank also, so you can't invest or put all your money in loans, right? You can't give all money as loans to customers. You need to put something in the treasury bills and treasury bonds. This is the same concept, right? Just to manage your portfolio, right? So similarly, as an investment banker, also you need to put some money in risk-free assets, and you should decide how much of percentage as a percentage, how much you are going to invest in risk-free assets, and risky assets how much. So ultimately, you shouldn't get put your client into trouble by putting all your basket in one, all your eggs in one basket, and also by taking not much of risk. If you don't take risk, you don't take returns also. You should give risk return also the investment of the client, but you must correctly take measure of the risk appetite level and what their expected returns also by gauging. So taking a strike strike a balance between how much of risk that your client is willing to take and how much they expect. You need to manage these portfolios. So then you take a decision accordingly. I am putting this much of money, 25% for an example, is free. 75 of 75, I am putting 25 in stock market, 25 in this, 25 in this, and so on and so forth. You must take a decision, right? So similarly, so on the same line, you have to take that decision, right? So a conservative investor, so they don't take any risks. You put all your money in fixed income, treasury bills and treasury bonds. Okay, you don't take any risk. Moderate risk taker, you put about 60% fixed income and 40% equity, right? So balanced person, so you need to give some return. You take some risk and we put about 60% in equity and 40% in cash and fixed income. So if you looking at aggressively returns, you put about 80% in equity, but if you make losses, that's going to hit you badly. And if you're aggressive investor, so you're looking at 100% in equity, right? So if you remember correct, when the first day we talked about Warren Buffett's portfolio in his video. So he has investment from Apple, so American Bank, so many few banks, and also the Ford and Coca-Cola, and so many. He has invested in so many companies. So he's basically, he must be definitely having some investment in uh, uh, in sort of fixed income securities also, but we'll only discuss the other day about your stock market investment. So even the stock market, he has decided according to his judgment how much you know he put in each of these investment. That's so he's an investor and also investment manager for himself. So there are people like that, but the ordinary people come and ask for expertise. So then in that case, you should have a fair idea about that. So right, great. So now, so these are some of the conservative person. So what are the options available for conservative investor? So those who are not willing to take much of risk. So basically, that kind of a person invest in US dollars about 25%, 50% in government bonds, about US stocks. US stocks is relatively stable, right? So big companies like Apple, Microsoft, the General Motors, it is as good as some treasury bills. 100 maybe last 20-25 years been growing at an exponential rate. So maybe 25% in that kind of CDs, very comfortable, zero risk kind of asset. Government bonds, again, the stocks, large US firms, there is hardly any risk, right? So that we talk in terms of US mentality, but if you take Sri Lankan context, we can't say the same, right? So moderate investor, so they can take about 20% large US stocks, 20% small stocks, real estate, again growing at a rate, 20% in bonds, 10% precious metals, and 10% in CDs, right? Certificate of deposits, right? The CDs. So it's very much similar to the fixed deposit which is available to corporates, right? So high aggressive depositor, they are looking at small US stocks which has a higher level of return. So real estate, again, expected return is higher. So stock of developing countries, some in fact they were invest in our stock market expecting a higher level of return, right? So stable markets, you get about 10 maximum 10% return. But so in Sri Lankan context, developing countries, they can give about 25-30% return. So expecting that return, so some of the aggressive investors can look at investing in stock market. They hardly invest in government securities. They again CDs, invest in CDs. So let's look at some of the returns of those. So some of the expected returns. So now these are the investment. So why they have aggressive investor go and invested in real estate, the expected return in 9.6. Stocks in their developing countries, return is 29%. That is no wonder so aggressive partner want to invest in stock market of developing countries. Developing countries, developed countries, again, the return is about 10-13%. But long-term government bonds, um, again 3.7%. Precious metals, it gives a very high level of return. So that's the reason why aggressive investor again wants to invest kind of that moderate kind of a investor need to looking at investing in precious metals also, right? So when you look at so taking investment decisions on behalf of your clients, being an investment manager, fund manager, so you look at whether the investor is younger person or older person, and you can take decision. Younger person, so they have a lot of time, so they probably can invest expecting money to multiply, right? So they can hold. So not needing liquidity, might consider investing liquidity high growth potential. So they probably expect fund manager to take risk and try to grow their investment rather than going for low risk assets, right? So investor is nearing retirement. So after retirement, he wants some money to pay off his pharmacy bills, medical bills, and things like that. Need continuous cash flow like pensioner. He needs pension to pay off commitments and pay off his farmer medical bills and things like that. So he's a person who is nearing retirement age. They need some liquidity, so that we need to give constant annual monthly income also. So you need to look at that two aspects. Young person uh, looking at options of growing their equity or investment, but older person can look at generate some income on regular basis. So so strong, the risk, if you take the risk tolerance, so also look at person who's take risk, aggressive person can expect you to invest in stock market, right? But if the stock market is doing well, you can go and invest in stock market. But so if you expect lower interest rates, so you can probably look at invest in long-term bonds also. So if you expect real estate sector to grow, you can look at real estate sector expecting relatively high growth also. It all depends on the requirements of the fund manager, your client, so the investor. So basically, so early stage, you probably invest in stocks relatively low amount of low level of investment in bonds and other securities. As you time passes on, so as the stage of life, the older the investor grows in, he wants to stock returns, investment in stocks to go down, and invest in fixed income securities to ensure that he gets the regular income source. So this is the perspective of a fund manager. So if you really take an opportunity to manage funds of a high net worth customer and need advice or work as a fund manager, we need probably, this is a basic understanding. You need to know a lot about the stock market, fixed income securities, and you need to have a high level of customer relationship, the communication, so everything. So if you are willing to get into that area, so those are some of the things that you need to look at. These are basic stuff on which you can do some additional courses, qualifications, and understanding, and you probably can talk to investors, and so you look at on your own, invest in stock market and experience how particular stocks do, and read through the prospectus, annual reports, and you need to do a lot of things. So if you are up to be a master fund manager. So lot of room for improvement. So this is just a start, right? So with that, I think it concludes, like I promised, the the stock market area, also the fund manager asset allocation strategies of a fund manager also. So let's move on to the final section. If you don't have questions, I think so. Just to recap everything, right? So we have to move on to the case study, right? So case study plus you have few questions, right? This slide you have questions. What the case study I want you to answer on your own. The what root cause for global financial. Can you go through the what is the root cause? I think what is the root cause for global financial crisis? That is the first question that you need to answer. What is the root cause for the global finance? You go through the article and find your own answers. So when we discuss, I want you to at least on OneNote put it in so in summary form, in a couple of words. What's your answer also? Then the second question is, why did the situation get aggravated? So we started with some reason. So then certain things happen in the market, which actually things got worsened. So what are those things? And there is a term defined, bubble burst. So what do you really mean by bubble burst, right? So finally, what did the situation? How did the situation disrupt the entire financial system? Like I said, I told. So if one country or the certain section of the economy go into bankruptcy or into trouble, the entire system get upset. Okay, disrupt the entire system. So what are the evidences you have in this case study for that, right? So you have both. I think you got the email and also all these things. You just go through this case study and find your own answers. And keep it ready. So I think now it's 4:20. So we'll give you about 20 minutes to read and understand and come out with your own answers to those questions. And so then there are from there on we take it on. So basically this case study in nutshells here and there captures what we've learned during last so far up to now, what we have discussed. And so global financial crisis, what exactly happened. So some of the things that we learned exactly uh, were the reasons, okay, in the systems, the deficiencies in reasons for this global financial crisis. You just read and understand and recognize and appreciate those aspects and find answers to the questions that I posted. So let's meet at 4:40, and we'll have a round of discussion. So I'll anyway, stay tuned. So I'm not off my video, but I'm on here. I'm here, and if you have any questions, you can put it in the chat box, and if you need, I can help you out. Right? So if you need any questions in your understanding a terminology term you don't understand, let me know. I'll then and there I try to explain. So 4:20 at 20 minutes, 40 at 4:40. Let's start our detailed discussions and find answers for these questions. Right? So if you have any questions, you can put it in the chat box. Now start. Time ticks. Start ticking. So hope You have you managed to read this? There are about 13, 15, maybe 10, 13. I can see, I think, including but at least 10, 12 people here. Hmm. So if any one of you, if you can take the challenge, I'll give you 5 minutes to 5 minutes. In one of you to, if you can give a summary of this case study, so that is good for you also. You can take that. Any one of you can take that opportunity. I'm always there to help you out. Let's 1 more minute. So for 40, anyone who can come forward can take that opportunity. Otherwise, I'll start the discussion. Simple as that. If anyone is ready, just let me know in the chat box. Say yes. Always you must take challenges in life. This is a small challenge. You can take small challenges. You are bound to take bigger challenges in your life. Simple as that. So for 40, so let's start our discussion and the case study. So I didn't see anyone in the chat box taking the challenge. So that, yes, it's up to me to take it forward. So I will take 5 minutes and briefly explain what this scenario is all about, so that just whoever has read through it and there are some areas that it is not clear, should be able to uh, everything can take it to your head and keep it in a steady way. So once I rush through the case study and give you a kind of a background to this, right? So so like I said, the main reason for this case to start, this global financial crisis started in USA. So they are, when central bank is the one who is actually deciding on the central interest rates, right? So they have lowered their interest rate in decades to very low level. It came down to very low level, and during that time there was a significantly high level of foreign funds came into US financial system. So as a result, they had a lot of money in the financial system. So that again, reduced the interest rate, overall interest rate. So that's the starting point. So when the interest rates are very low, those who want to take a loan, so they are very much encouraged, right? Interest rates are low now, so there's some incentive for them to take loans. So they, driven by low interest rates, people started taking loans, particularly the home loans, right? Home loans, there's a big demand. Uh, so, looking at this opportunity, the house construction industry also started, constructing, big housing schemes, apartments, right? So there was on supply side, they also got activated, and so demand side, so banks were ready to give loans, and people took the loan and bought the house. So simple as that. So so since the banks are ready to give loans, there was huge demand for houses, right? And so then whoever who came to the banks, so sometimes bank actually didn't bother to look at their income, their, whether they are 5Cs, that model, they didn't apply 5Cs model and started giving loans left and right, right and center, right? So they started, it's a credit is all about sales functions those days, right? So they were given thumping incentives for selling loans. So that was the case. And since those who took the loan about a year ago, this so yeah, price of the house has gone up. Then they came for the second loan. So the second loan, they actually didn't really meant for housing purposes. They took money and used that for consumption purposes, right? That's where the problem started, right? So at some point that comes to an end. So then now second round, it had not gone for housing purposes. People started taking money and they spent lavishly, and the one end people who started constructing houses kept on constructing. Supply side, there was an increase in number of units houses, and then uh, but in terms of repayments, so they did some ninja, so no income no job group also got loans, so they started defaulting. So as a result, so they felt the industry felt the shock, right? So there's so much of units, and also banks also got message that repayments are not doing well. They stop giving loans. So as a result, there was opposite happened. There was huge supply for houses, low demand, right? So as a result, now the at one time their value have gone up. Now value started coming down slowly, and after a while, some group of housing loan customers started defaulting, right? So about 8 million homeowners, they say 8.8 had zero negative equity. So they actually they didn't want to because they didn't have any equity. No, so there's nothing. No, they have not lost anything. They have just walked away and they didn't pay loans, right? So the huge problem in US market, and in fact, we learned about collateralized debt, mortgage-backed securities, right? When leasing companies, then they don't have enough money to lend. No, what they do is they keep their leasing books contracts in investment bank and take money. So similarly, these financial institutions also, so these home loan contracts kept as a security in investment banks and took money for their lending. So that's how they've grown their the books, loan books. So these investment banks, so they actually looked at very lucrative interest rates and receivables, and as a result, they expecting very high level income. But when the housing loan customers started defaulting, these banks also could not repay investment banks. So there again, so that shock was pretty evident in the market, and as a result, these investment banks share price also started falling down. So the market has come down. So these investment banks in share price crumble, and so they started falling on day by day, started falling rapidly. So the some of the companies in the share price came to bare minimum level. So they completely lost. So this mortgage-backed securities is the one similar to leasing companies, but they have taken from investment banks, right? For their security. So subprime is not the perfect customers that they have lent it. So this is had a crisis, and so crisis, after crisis, and all the investment bankers started falling one after another, right? So as a result, so within the banking sector, there was so much of a trust issue. The bank was not able to disperse loan for big customers who actually wanted fund finances for working capital. So as a result, this economy also started crippling. So because the funding didn't go to actually the targeted, much needed targeted group like business sectors. So business also started falling. So the entire economy started falling. So as a result, the interbank money market, though I told you, when banks have liquidity issues, they go to interbank money market to ease out their liquidity issues. But interbank money market, they, because of the trust issues, they also resisted giving money to their counterparts, other commercial banks. So the entire financial systems got hit, and as a result, entire financial system, affected. So that's the. It took about 10 minutes for me to summarize this story. So we'll straight away we'll go to the questions. I at least hope if you all can give your answers in very short in the chat box for each questions. I'll give you 1 or 2 minutes and I'll give you your answers. That's how I'm going to work it out. So I think hope you will cooperate with me to make it interesting. So the first question is, what is the root cause? What is the root cause for global financial crisis? What is the root cause for I think it in the first para itself, it all started in US. So you have the answer. If you can put it in writing, 1 or 2 words, chat box, you can take it on from there. Anyone? Couple of seconds. I hope started typing. No. So we'll get to the answer straight away. I think a combination of low interest rates and large inflows of foreign funds help to create easy credit conditions. So that's where the answer, you can find answers there, right? If you have printed version or some technical way of highlighting, you highlight it. So the main reasons for this issue was the low interest rate prevailed in US at that time, and also large inflow of foreign funds to US, right? So as a result, home loans were cheap because of the low interest rates, and so more people applied for home loans. So demand for home loans. So as a result, home prices also gone up. So value of houses also gone up. So loan conditions also relaxed by the commercial bank. So those are some of the reasons for this situation. Interest rates came down, foreign funds, free flow, and demand for housing loans, low interest rate regime. So housing loans, housing prices gone up, and relaxed loan conditions. So those are some of the reasons. So next question: why did the situation get aggravated? Situation get aggravated. So you see the answers in the next para. So yes, we have relaxed the loan conditions, but so going beyond that, banks have taken the approach ninja, right? So they didn't look at whether these companies, individuals have income, job or asset to back their repayment capacity. They didn't have a proper credit evaluation criteria. They didn't use 5C models to evaluate their customers. So as a result, they have funded subprime subprime customers. So that is one reason why so these things have started to aggravate, right? So, and also not looking at the customer repayment capacity, banks started lending lavishly and aggressively, and started giving second loan also, without taking into account the repayment capacity. Looking at the price valuation of the houses, they have given the second loans also. But usually if you practice normal credit evaluation, you have to look at their income sources before taking into account the second loan. So that those are the two things. They did not practice proper credit evaluation criteria, didn't follow proper credit evaluation criteria, 5Cs and all. So that is they didn't have the proper policies in place. So as a result, they actually started funding the subprime customers, and also without looking at the repayment capacity, they started lending giving the second loan also. So those are some of the reason for not situation actually getting aggravated. So what do you mean by bubble burst, and provide an example relating to local context? So can relate this to Sri Lankan context. Can you come out with an example? Something close to this happened in Sri Lanka in 2000, maybe 2011-12 period. So if you can't give an answer, can you tell us? So what's that locally what happened? Bubble burst in Sri Lanka also 2011-12 period. So what that bubble? What's the asset category? This time around, not loan, housing loans, something else. The bank product went into trouble. Similar scenario, but different product. So bubble burst. What do you mean by bubble burst? So simply there was repayment issue from the customer side. They started actually defaulting, avoiding the banks, and so sometime back they could take the second loan and get the refinance the second loan and make the repayments. But the banks also got to know the customer is in trouble. He should take things under control, and so but it was too late. The some of the homeowners had zero or negative equity. They didn't have any equity. So because their prices of houses have come down drastically, so they are the prices of houses has came to zero level, zero value, but they had a loan liability, but they didn't have an asset. Value of asset zero, but they had a liability, housing loan. So negative equity, right? That's how negative equity created, because they had a loan, but their housing loan prices have come down, valuation came down to zero level. Now the asset value is zero, but they have a liability of some value. So when you have that, your net worth is zero, equity is zero. So that's the scenario. So then the housing loan customers defaulted, housing prices came down, so negative equity resulted the homeowners, and also the value of prices of houses came down to two reasons: because the bank stopped refinancing, and also the supply of houses continue to increase. So as a result, the supply side, there was increase in a high number of housing unit compared to the demand. So that also, rapidly, uh, rapidly uh, resulted dropping the housing prices. So that resulted negative equity of customers, and that was the bubble burst, because the entire thing collapsed. So, uh, so in nutshell, so the asset liability mismatch, right? Asset liability, the home loan owners could not pay their loans due to the bubble burst, in the asset bubble burst. The liability was there, negative equity resulted. So as a result, they could not withhold the situation, could not stand on their feet. So, so what is the example you can quote in Sri Lankan context? Can anybody get that answer? No. So pawning, I think gold. I think 2011-12. So there was a huge issue in gold prices have come down drastically. So although we also have high gold prices right now. So similar scenario happens if the gold prices come down. Okay, now it's about 200, 120,000 in the market. So we our owning we own about some finance company give about 100,000 so rate. So if, let's say, if something happens and gold prices come to about 75,000, 50,000 tomorrow, so do you think these pawning customers come and pay their dues? So I don't think they are uh, worried to take their money, the jewelry articles back. So let it keep it in the bank, and so they will simply walk away. As the home loaners in USA what they have done during global financial crisis. They will do the same thing. So a similar situation happened in Sri Lanka. So as a result, two state banks, in particular, People's Bank, Bank of Ceylon, had actually incur very high losses in pawning, because pawning customers simply didn't come to actually settle their pawning and get their articles back. And also their value also come down, and so they could not. Banks also could not get their money back by selling in the auction. So that resulted the havoc in the industry. So you can relate that to using that example. Finally, how did the situation disrupt the entire financial system? So what did happen in USA? Uh, so so what a very tragic situation in USA. So looking at the lucrative returns, investment banks pump money into the financial system. But when the housing loan customers started defaulting, uh, so these share prices of investment banks also started, coming down very rapidly. So as a result, they also could not withstand this crisis, and they lost. They went bankrupt, and so as a result, so entire financial system uh, went into a crisis, because so these investment banks pumped a very high high level of funding on this investment. So when these companies losses, entire systems gets losses. So and finally, uh, so when these companies investment went out of business, and the worst thing happened was US financial system was very weak, and the banks was not able to disperse loans for industries. So as a result, the entire economy collapsed, right? So that crippled the entire economy. And finally, the interbank money market, there was the trust issue among the banks, interbank, all system also. So that also created havoc in the entire system, and the entire finance system resulted with that very high level of collapse. So entire system collapse. So I think the US, the government had to come and uh, save some of these big companies, but but the US government actually pumped about 700 million to safeguard these uh, big companies, but not to but not is not successful. So but entire system went collapse. So I think this is the whole scenario. So learning from this to strengthen the financial system, only I think Basel 3 they have introduced the high quality uh, assets, capital requirements. When the so investment banks kept on growing their assets, no, so commercial banks, so to curtail, to stop doing that, they now in the Basel 3 they wanted to keep aside some capital. If they don't have capital, they can't just simply grow their books. So in a way that controls. Also, they need to have shareholders capital, uh, quality capital for them to grow like that. So if you don't have capital, they can't simply take risks. So that controls the entire system. That will actually prevent the entire system going into trouble. That's the way that I think Basel 3 is trying to solve issues. And liquidity also ratios, two ratios: liquidity cover ratio, stable funding ratio, stable funding ratio. All these ratios also introduced to make sure that the liquidity issue, so which actually happened, the liquidity crisis in the system, also resulted this the crisis in during global financial crisis. All these ratios, liquidity ratios, the capital ratios, also actually introduced to control and stop any future crisis of that statute magnitude in future. So maybe there can be 2010 to 2020. There's so many lessons learned in other parts of the country, the world. So that also research done. So maybe we can further strengthen, maybe with the global, maybe with the Basel 4 or something like that. We can further strengthen the financial system and improve the transparency and entire system. So I think with that, that concludes our normal the course, and hope you have I was able to give some understanding into this area. Some of these areas are little complicated, but I tried my level best to make it simpler, and hope so. I don't see any questions also in the chat box. Also, I always come and see if you have any clarification you need. So I think hope it was clear, and slides are also given details. If you need, you can go through it and understand. So my section, I'll give you a 20 marks question, and so I think we've circulated some standard questions in the revisions section. You probably when you do your revision, you try and do those questions also, and so maybe one or two questions can appear in the exams in 20 marks. So question. So that's it from me. And if you have any questions, I will wait for a couple of minutes, and I can also, if you have a question, you can raise here. I can answer. So that's it from me. So all the best for your future. I think uh, all your future endeavors, whether it is in studies, the career, or your employment, and all the best for you. So if you have any question, you can put in the chat box and you can answer. If not, That's it from me. All the best. Thank you very much.